The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Please consult your tax advisor, even if it's us, to find out how this may apply to your specific situation.
Hey listeners, and welcome to Tax Trails. On today's episode, we're going to be interviewing one of the partners in our Spanish Fork office, Russell Olsen. Here are your hosts, Derek and Spencer.
Thanks, Chandler.
Thank you, Chandler. We're super excited today because we have one of our esteemed partners out of the Spanish Fork office, Russell Olsen. How are you doing?
I'm doing well, thank you.
Yeah, we're so happy to have you here on this partner spotlight, this tour of the three offices that we have.
It feels like the world tour,
Yeah,
but it's just the Utah tour.
yeah. But Russell, why don't you go ahead and kind of share with us a little bit of background about yourself?
Okay, well, I grew up on a farm here in Spanish Fork, and I remember a time when my dad, I think he did this on purpose, but it was on a hot summer day. We were cleaning ditches, and he told me that I should get an education.
That's a classic
Yeah.
parent thing to do.
And I didn't really think much of it then, but I do remember just thinking, yeah, I'll probably go to school. So that was the intent. I was going to go to school. I didn't really know.
Was it an easy sell because you're like, if I get an education, maybe I don't have to clean ditches?
Clean ditches.
Is that?
Yeah, I think that was what was
Yeah.
done on purpose. He was
Yeah,
like,
exactly.
"Okay, we're going to encourage this guy to do something besides
Yeah.
clean ditches." But
Yeah.
I still clean ditches, by the way. But
Yeah.
So when it came time to choose, like what was I going to go into? What was I going to study in school? I had taken the ACT test, and I had done better in the math section than any other section. I'm not telling you that I did good in math. I'm just saying I did better in math than anything else. And I thought, well, you use math in accounting, so I guess that's what I'll go into. And that is the thought that I put into my career choice.
What a pipeline.
That's great. Come to find out, there's not as much math in accounting as you might think there is.
No, and there's not. And whatever math there is, the computer just takes care of it.
Exactly.
So anyway, yeah, I went to school, got my CPA, started working for a firm here in Spanish Fork in 1996, and have been doing mostly taxes since then. I did some audit work also, but mostly just small business tax. Having grown up on a farm, I kind of became the resident, farm tax guy. So
Yeah.
I have a handful of farmer clients, and I know how to talk their lingo, and so.
Yeah. And how long have you been with Larson then?
Well, I guess I would have joined Larson in 2003, the end of 2003.
Mm-hmm.
So 21 years here, and 7 or so years before that. So I've been at this for almost 28 years.
Wow.
So
Wow, you got to do something big for your 30 year. I'm 28. I'm turning 29 this year. And I turned 30 next year. Sorry. Hopefully that doesn't make you feel
no, that's fine. It's
aged.
maybe we'll buy some apples for the office or something. I don't know. Do something big like that.
I should say, I was born in 1996, so if your career was a person, it'd be me.
There you go.
Nice, Chandler.
Awesome. Well, let's go ahead and get into the topic today. Russell, you kind of wanted to talk to us about trusts and...
Yeah, so you're a farm guy, but you also know a good amount about trusts.
I do, and I guess I just, from the time I started back in 1996, the firm that I worked at before Larson merged with us, I just had the opportunity to do a lot of trust work, and I guess it's trusts are really, really important for the people that you leave behind. Trusts don't do much for the person who sets them up. It's set up in order to facilitate the transition, or at least the trusts that I'm talking about. There's all different kinds of trusts, but I'm specifically talking about the types of trusts that would be used by a family to transition someone's estate to the next generation.
Got it.
So there's some really compelling reasons to set up a trust, and there's some misconceptions too about what to do at the end of, as you reach the end of your life. But one of the things I think, one of the first things that you benefit from by utilizing a trust is that your assets can be transferred to your heirs without probate. Because in the absence of the trust, even if you have a will, if the trust isn't there, then the courts, your estate still goes through probate, and then the court sees that your will is taken care of. But when you have a trust, you get to name the person who's in charge of making sure that your will is carried out. And so that's one of the primary benefits of setting up a trust for these purposes is to avoid probate.
Yeah.
The other problem with probate, not only is it time-consuming and probably annoying, it's also public. Like anything that goes through the courts is public information. So
Interesting.
some of those family things, family assets and property that you have that you might not want the world to know about is exposed to the world. So that's another reason to set up a trust and to avoid probate.
That's a good thought. Yeah, I mean, you want somebody you know and trust. So often, the person interpreting your will in the trust is a family member, oftentimes, or a close friend, right? And they probably actually understand what your will says versus leaving the interpretation of the will up to
a court.
A stranger, court. So yeah, that makes a lot of sense.
Yeah. And the other thing that a trust does, and I kind of already mentioned it, and that is that you get to name the person who carries it out. And you get to give them all the instructions you want, so that your assets are dispersed according to your wishes. During one's lifetime, so somebody who sets up a trust, say a husband and wife set up a trust, they're still in charge. In fact, sometimes they call it a living trust, but it's a trust that is an actual disregarded entity in the eyes of the IRS. So you set up this legal document that puts all of these things in place, but during your lifetime, it's kind of like it doesn't really exist in the eyes of the IRS. So your tax returns are still done just like normal. Like your bank account and your home might be in the name of the trust, but the income from your bank account just goes on your personal tax return as if the trust didn't exist. And it doesn't really, I've utilized the term, this is my own term, I call a living trust a legal ghost, which just means it doesn't, well, like I explained, it doesn't really exist in the eyes of the IRS. But the minute that one of the couple dies, the trust then comes to life, and then it becomes a legal entity recognized by the IRS and is set up to handle the transactions of the deceased person. So
That's interesting. I think, before I even knew about trusts, it's like that would be something good to know. And I didn't, before I even started doing tax work, I never really thought about trusts and how that all works. And so I think that explanation can really help out people, because I think it can be really confusing. You're like, well, how is this going to be taxed? And
well, if you think about, because I get this question sometimes, like when somebody passes away, for that year that they pass away, well, how do the taxes work then? Like, do you just, like, where do you put this income that maybe came in after the person passed away? And it's really kind of simple. When somebody passes away, before that date, everything goes on their 1040, their personal tax return. Everything after that date is now shifted over and is reported on the trust. So that's just an easy way to think of it. It's like, okay, well, that makes sense. That
Yeah.
person no longer exists. Now the trust exists, and we move forward like that.
Yeah.
So,
Interesting. So someone who's listening might be like, "Oh, wow, I should probably think about, doing a trust because of the asset protection, because of the flexibility and control of your distributions, of making sure it doesn't get into probate and so on. And it's a good succession plan, I would say. How would one go about to create a trust?"
well, the actual legal work that has to happen in order to create a trust, that would be done by an attorney. We as accountants don't practice law, and that is considered practicing law. So it would be a matter of getting in touch with an attorney and having them draft up the document. And while we're talking about that, I just want to touch on one of the misconceptions, and that is sometimes people think that, like, well, I don't need a trust because I don't have an estate tax issue. Like at this point in time, at this moment, a married couple, unless their estate is worth more than $25 million, they're not subject to the estate tax. And so sometimes people think, well, I'm not anywhere close to that. I don't need a trust. Well, that's not true. And it's not true because of what I already explained. Like, it's not, like, yes, we use trusts to reduce estate taxes, but for most of my clients, we use a trust, like I've already explained, to avoid probate and to facilitate the passing on of assets. So if you own anything, you should have a trust. Like if you own a home or property or
Investment, like big
investments, a car, like it's really any asset at all that you own, if you die, it's either going to go through probate or it's going to be handled by a trust. And so the misconception is that, oh, I only need a trust if I have an estate tax issue or if I'm going to owe estate taxes, and that's just not the case. Like anybody who owns anything ought to have a trust.
Interesting.
That's good advice.
So you consult that professional and they'll tell you, yes, you should have a trust, and they'll help you set it up legally. What kind of happens next?
So oftentimes the attorney will draft the document which establishes the trust, and it's not actually filed necessarily anywhere. It's just a document in your files. But then one of the things that does need to happen, and oftentimes the attorneys will facilitate this, and that is you need to get like the deeds on your home or any other property that you own switched over to the name of the trust.
Got it.
And that's an important thing. Like, it's great if the document's in place, but if you don't then go and change the names on the properties and the investment accounts, it's as if the trust
Doesn't own them.
it doesn't own them, and those items still have to go through probate.
Interesting.
So it's the document, and then there's just that thing afterwards that has to happen, and that is to get the trust name on your assets. Now, I'm going to maybe take off on a tangent here, maybe. There's an exception. It's my opinion that retirement accounts do not get put in the name of the trust. Don't name the trust as the beneficiary of a retirement account. You should name the beneficiary of the retirement account those people who you want it to go to.
Oh, interesting.
And I'll kind of explain
Yeah.
why. So when you inherit an IRA, you have a choice. You can either take all the money out immediately, and when you do take it out, it's going to be taxable. Retirement accounts are one of those assets that doesn't get a step up in basis or anything like that. If you take that money, it's taxable to you just like it would have been to the deceased. So you have a choice, and you have a certain number of years to pull that out. So if you want to just pull it out now, you'll pay the tax, but then that will be your choice. If one of your siblings or one of the other heirs doesn't want to pull theirs out, you can only do that if you're each individually named as a beneficiary. If you name the trust as the beneficiary, then everybody has to live with one choice.
Either one of you does it, or all of you do it, or none of you do it.
Yes,
Yeah,
because the trust is the only one that can either take the money, and which was going to be subject to tax, or leave it in there, and then you're waiting for your inheritance if you're one of the heirs that is
Right.
ready for their inheritance. So that's one of the assets that I'm going to tell you that, in my opinion, should not be named in the trust.
Interesting.
Huh, a little tidbit of knowledge there.
In fact, in a certain way, a retirement account like an IRA or a 401k is technically a trust. It is a trust, and the trust has beneficiaries that you name.
Yeah.
So, and it has trustees, just like the trust that you would set up. So, retirement accounts are already in a trust. You just need
So don't
to
worry
name them.
about doing that.
Yeah.
For those. Okay. So, all right. So, are there any big? So, other than trusts, are there any other big issues or misconceptions that people have when they're getting toward to their planning at the end of their life?
There are. One thing that I've seen, not too often, but often enough that it merits a comment here, and that is, some people have the idea, like, whether they have a trust or not, they think that they need to transfer the assets to their heirs before they die. And the example that I've seen is somebody transferred it was either their home or just a piece of real estate to one of their heirs before they passed away. And that causes tax problems. That's a huge no-no. Like, people think that they're doing a good thing.
Yeah, they're
Right.
trying to get it into their
Yeah, so it's just
descendants'
taken
name.
care of.
Yeah, before, so they know, they can
There
rest
you go.
easy.
This is yours now.
So let's just throw out an example of, so somebody has some property and it's worth $500,000, but it's property that they had bought 50 years ago for $20,000. So there's this gain. Like, if the person sold it before they died, they'd have this $480,000 capital gain.
Yeah.
So when you gift something, that tax basis of $20,000 goes with the property to whoever you give it to. So now, by gifting it before you passed away, you've created a $480,000 capital gain for the person that you love, and you didn't need to.
Yeah.
You needed to let them inherit it after you pass away, because when you pass away, your heirs receive a step up in basis to whatever that property is worth on the day that you pass away. So by waiting and letting them inherit it later, you save them, like,
480,000 of.
well,
If they were to
gain.
sell it, like,
You save them the tax on a $480,000
Yeah.
capital gain.
Right.
you wouldn't necessarily pay 480,000, but
Right.
you would have to pay tax on that if you were to sell it.
So does that
With that
apply
fair market
to other asset classes as well?
Well, it does. It's just that property is the easiest one to wrap your
Yeah.
head around.
Right.
All asset classes, like even an investment, like investments, mutual fund stocks, that kind of stuff, the same thing applies. I'm just going to say it applies to everything except for
Retirement accounts.
retirement accounts.
Yeah.
And there's other odd exceptions that are beyond the scope of this conversation.
Yeah. So somebody had started a business, many years ago, like a dog grooming business or something, and had grown it, and it was really valuable. And
So Yeah, that's a really good example because I'm sure that dog grooming businesses are super explosive, and you create that and it just
Yeah,
blows up, and
yeah,
that's what's
they
happened
do.
here.
Well,
That's
people love their dogs.
Absolutely. So a trust in this term, say the dog grooming business is in the form of an LLC or an S corporation or whatever.
Okay,
That's
yeah.
I think maybe you've covered some of those
Yeah.
subjects as to why you would do one or the other.
Yeah.
So either way, the trust can be instrumental in passing that business on to the next generation without, well, it's never going to be without problems.
Sure.
Because small businesses and families,
There's
Yeah.
there's
Have
like
problems.
personal problems.
sure, but on the tax side, that you can make it as smooth as possible
Yeah.
by incorporating a trust into your plan.
Awesome.
Yeah. Yeah, that makes sense. Well, Russell, we appreciate you talking to us today about the wonderful world of trusts and estates.
Exciting stuff.
Yeah.
Yeah, it's important stuff, and it's relevant to.
I think it's more relevant now than it was a long time ago, especially assets such as buildings and property have really skyrocketed
Yeah.
within the past couple of years. And I was reading this, me being a part of tax groups online or whatever, with the baby boomers, there's a big, huge wealth transition that's supposed to happen within the next, I don't know, 10, 15 years, where a lot of the older generation of Americans are going to be passing away. And so there's going
Right.
to be a huge wealth transition, and that's where trusts come in.
Yeah, I mean, and you look at a place like Spanish Fork, Utah, right? It used to be like a farming community based almost entirely, right? I mean, that's what you grew up in, Russell.
Yeah.
But if you drive here, I mean, from basically, Spanish Fork, Salem, up to North Ogden, it's one continuous just suburban sprawl now. Like this is, and so but you can imagine there are all these farmers who lived here a few generations ago or whatever, and they had this land, and that stuff is appreciated massively, right?
Yep.
And is continuing to do so. So, you may think of this humble farmer maybe didn't, on appearances, maybe didn't, look like they're worth a lot of money, but actually there's some serious assets around now, you
Yeah.
know, and you gotta be prepared to handle that, right?
Yeah, that's interesting, and I do have some clients like you're describing that own some property around, and their net worth is probably more than they can imagine,
Right.
and they just
Yeah.
go home at night and eat steak and potatoes and go to sleep.
Right. Right.
Not even thinking about it.
Yeah.
Yeah. That's cool. Thanks for coming on with us today, Russell. We really appreciate it.
Well, I'm happy to do so, and it's fun. I like to talk about things that are important to people. So.
Oh, good.
Awesome. Thank you, everyone, for listening. We appreciate it. For more information about Larson Company and other educational material, you can find us at our website, larsco.com, also linked in the show description. For questions or suggestions on future episodes, you can contact us at larsonpod@larsco.com. If you would like to learn more about today's episode topic, additional resources can be found in the episode description.